So this video is called 2025 Recession. Here's what the experts think.
Economic word of the week. Trump session.
It's just policy uncertainty. Markets don't like it.
There is going to be a period where it's going to be panic at the disco.
Yes, tariffs at that kind of level, that would not be good for U.S. economic performance.
Fears of an economic slowdown induced by the president's trade policies have escalated this week after an interview with Fox where he said this.
Are you expecting a recession this year?
I hate to predict things like that. There is a period of transition.
The implication being that Trump likely intends on pushing forward with raising import tariffs, even if it means creating some economic pain in the short term. And boy, did financial markets react. The S&P 500 dropped nearly 2% at market open and down nearly 3% on the day. The Nasdaq composite of US tech companies took a 4% hit, and it was a bloodbath for some individual stocks. Tesla down nearly 16% on the day, now trades 54% below its all-time high. Nvidia saw a couple $100 billion of value wiped out and sits 30% below its peak valuation. Not everything was in the red, but it was a pretty brutal day for stocks. The comments from Trump were accompanied by the release of new economic data and experts weighing in with their forecasts. The Federal Reserve Chairman Jerome Powell, JP Morgan, and Warren Buffett, just to name a few. So let's see what they had to say, starting with the investment bank Goldman Sachs. To start the week, Chief Economist Jen Hatzowitz released a research note in which Goldman provided a downgraded forecast for the economy in 2025. This comes just a few months after they provided a very positive outlook.
We see several strong tailwinds pointing to solid US growth in 2025. Our baseline forecast is 2.5% growth, well above consensus.
They viewed inflation to be on a continued path towards the 2% target over the following years, and that Federal Reserve rate cuts in 2025 would be a tailwind for business growth and investment. But there was one risk that they noted could derail their prediction.
The biggest risk to our outlook is just how much of a tariff increase the Trump administration will impose. But in our risk case of a 10% across the board tariff, we'll actually get a reacceleration in inflation to 3% plus, at least for a period of time.
That makes sense to me, right? How can you expect there to be an additional tax added to every good that's imported in the US and it not cause inflation? Like, I don't know about you, but I'm sick and freaking tired of inflation. Just yesterday I was watching this video. I'm not in the market for a new car, but this one car video pulled up on my feed and it was talking about how new cars are not selling. Like, I don't have the data in front of me, but new cars are not selling at record numbers. And in so many comments, because of course I wanted to go read the comments, so many comments were talking about how, of course they're not selling. Why would I pay $80,000 for an F-150? Why do I need to spend $70,000 on a family car? Right? It makes total sense why new cars aren't selling. And that's just one example, right? And so many things have gone up in price. I think, hear me out, I think it would be a great thing to have a little bit of deflation going on. But deflation can spiral fast. Deflation can lead to really bad circumstances. For example, let's say I wanted to go buy an F-150, right? I would never buy a Ford, by the way. My wife and I, we had a Lincoln Navigator, and that thing was broken at all times. I mean, we bought it certified used, and the certified used warranty was better than new. By the way, total life hack, get a certified used car. We got a certified used what is it called, a Lincoln Navigator, followed by a certified used Lincoln GX, or not Lincoln GX, Lexus GX. Your warranty is longer on the certified used than it is new. Total life hack, by the way, and you pay less money. Like, who would not do that? Anyway, point being is that Ford product, I remember specifically telling my wife one day, I said, your car is either broken or about to break at all times. There is no point in time where I felt comfortable in that car. It was so unreliable. So I would never buy an F-150. Never. Point is, if I were to go out and buy an F-150 and it costs $70,000, and that same truck used to cost $35,000, and these are not crazy numbers here. The prices have like doubled in some places. And we see that price come down to $60,000. There will be a segment of the population that's like, finally, people buying the dip. People buying the dip. This is exactly people buying the dip. Finally, the price of the F-150's gone down. Let me go buy it real quick. And then there's other people who are saying, well, if it's gone down 10,000, why not let it go down 20,000? Right? That's so interesting. I didn't really make that connection before, but deflation is exactly somebody buying the tip. Imagine the price of the truck was up here at 70,000, and then it came down to 60,000, and then it came down to 50,000. And of course, more people are more interested. But those same people who are buying at 50,000, there's still this regret in the back of their head, like, well, you know what? Maybe if I held out, it would be down at 40,000. And then the truck goes down to 40,000, and then more people buy in. But the people who are at 70,000, they're so underwater on that loan at 60,000, at 50,000, right? They're super pissed. They're telling all their friends, don't buy anything right now because prices are coming down. And as they're going down, less and less people are buying, which causes a huge problem, because if the prices of everything are coming down, people are waiting for the prices to continue to go down to find where that bottom is before they start to buy. And then the spiral starts. The spiral starts because it's like, well, if Ford isn't selling trucks at 70 or 60 or 50, how much lower can they go? And then Ford makes a decision. Look, we can't keep employees at this point. We're going to have to start letting people go, because we used to enjoy a $50,000 profit margin on every truck we sold. And now our profit margin is only 10,000 or 5,000. And so then you've got a huge swath of people who are getting laid off, right? So deflation can spiral out of control very, very quickly. But can't we at least get a break in prices? Can't we at least get a break in prices? Yeah, Lars, exactly. It's like buying a stock on the way down. Don't. Yeah, that is what deflation looks like. And on the inverse side of it, right? Let's look at Tesla. On the inverse side of it, inflation means that people are wanting to buy something before it gets more expensive. And we're so used to things costing more money. In fact, I used to work at State Farm Insurance. And I remember this was when I was going to grad school. And I was working in an agent's office. And people would come in and be like, oh, the price of your insurance is too high. And I would look at them and I'd say dead in the eyes, because it's 100% fact. I said, the insurance cost today will be the cheapest it will ever be for the rest of the history of time. It will never be less expensive than it is today. It will only go up. That's also proven out as well. So inflation causes people to buy things faster because they're nervous that the price could go up. Deflation causes people to not buy things because they think of the price will go down. Both in a nutshell can cause their own issues and have their own benefits. Let's be real here. But a deflationary spiral can get a lot worse than an inflationary environment, right? While it sucks that it's inflationary, right? That doesn't mean that we are in a death spiral in the economy, which could happen with deflation.
What was only considered a less likely risk case in December now appears to be playing out. Hatzowitz in his press release said, we now see the average US tariff rate rising by 10 percentage points this year, twice our previous forecast and about 5 times the increase seen during the first Trump administration. A large part of this comes back to Trump's plan to install reciprocal tariffs and how broadly they will be applied. The European Union, for example, has a value-added tax, or VAT, of about 20%. That tax applies on all goods and services sold domestically within European countries, but it also applies to companies importing goods, say from the United States. So in that respect, the VAT kind of acts like a tariff on US imports into the EU. Except there is a major difference. If the business imports goods from the US and then sells them in the EU, they can usually deduct the tax when making their VAT declaration. I'm not a tax accountant, and I'm certainly not a European Union tax accountant, so I'm not going to go into the fine print on this, but essentially the Trump administration views the EU's value-added tax as equivalent to a tariff, at least according to Hatzowitz, meaning Trump may place a 10% or more tariff on EU imports as a retaliation.
Then the more near-term impact is that if you increase tariffs, there is going to be some impact on prices. The PCE price level, by our estimates, rises by about 10 basis points for each 1 percentage point in the average tariff rate.
Which, in simple terms, means possibly 3 to 4% inflation rather than their original 2.5% forecast. It's also caused Goldman to lower their projection for economic growth in 2025 from a 2.4% increase in real gross domestic product to just 1.7%. And specifically regarding the chance of a recession where GDP actually contracts for multiple quarters in a row, they raised their probability to 20%. This sentiment was echoed by another big investment firm, JP Morgan, although their view is much more negative. They also released their original 2025 outlook at the end of last year. Their projection projection for global GDP growth was 2.5%, with core CPI inflation remaining about its then level of 3%. Again, just like Goldman, JP Morgan didn't believe that Trump's economic policies would be as aggressive as they've been, stating our baseline view anticipates a version of the Trump presidency that is tamer than what he campaigned on. A key risk to the outlook is if policy shifts are more extreme. So again, over the weekend, as it became clearer that Trump is adamant on large, widespread tariffs, JP Morgan's outlook has become more bleak. Back in December, they predicted a 15% chance of a global recession by mid-year and a 30% chance by the end of 2025. That risk has been upped to a 40% probability of recession by year-end, with team leader Bruce Kasman stating, "We see a material risk that the US falls into recession this year, owing to extreme US policies." And we also got an update from...
Well, if you remember, there was recession is defined as 2 consecutive quarters of negative GDP growth, right? So if GDP isn't growing 2 times in a row, that is considered a recession. There was, I forget what it was. Recession during Biden. I remember specifically there was some point in time where, and I'm sorry, I didn't have this handy ahead of time. I didn't think about it. But I remember specifically there was a point in time. Oh, that was in 2020. Here. Open a new tab. And then make this as big as possible. There we go. Hell yeah, let's go. All right. So there was a point in time in 2022 when there were 2 consecutive quarters of negative GDP growth, right? Technically, by the books, that is a recession. But if you remember, because politics seems to be the most important thing in everyone's lives these days, they would not admit that it was not a possibility. They started changing the definition of recession because they didn't want to admit that Bidenomics was responsible for that recession. Two years into the presidency, mind you. It wasn't like it just rolled over from one to the other. 2 years deep into the presidency, they started changing the definition of a recession. Now, here we are in 2025. If this were to happen, you may not even note it. You may not even notice if this happens. You may not have even noticed if this happened, right? Because I don't think many people are ever thinking about how, oh, the Great Recession of 2022, right? So the fear word of recession really sparks back to 2008, 2009. This is around the time I graduated with my MBA, December of 2008. And it was a horrible time to get out of college. I would much rather have been in college for the next year than be out of college at that point. And that's the one we all remember. That's the one we all felt. So when we hear the word recession, we really think about how that was brutal to the whole economy. But then again, you know, the COVID recession, just like that, it was gone. The Biden recession, just like that, it was gone. Could we see the same again? Maybe. But the recession fear word certainly is the buzzword of the day right now.
Morgan Stanley along similar lines, a decrease in outlook for GDP growth to just 1.5%.
Yeah, Momo gets money. He remembers. I remember when they changed the definition of recession under Biden. Yeah. I'm not crazy. I remember specifically them saying, well, it's not technically a recession because, you know, of X, Y, and Z, even though the definition says that it should be. Yeah.
And an increase in their inflation expectations to 2.5%. But as gloomy as all the headlines look this week, downgrade this, worsening conditions that, the economy is actually in pretty good shape. Over the weekend, we also heard directly from Jerome Powell, the chairman of the Federal Reserve. He gave a speech at the University of Chicago Booth School of Business, providing a much more...
By the way, last November, I got to see Jay Powell in the flesh. A little bit shorter than I expected. A little bit shorter.
Balanced outlook.
Despite elevated levels of uncertainty, the U.S. economy continues to be in a good place.
The U.S. central bank's goals are to maintain full employment and to keep prices as stable as possible. And on those fronts, the latest data is pretty positive.
Many indicators show that the labor market is solid and broadly in balance. The jobs report released this morning showed employers added 151,000 jobs to payrolls in February, and the unemployment rate ticked up 0.1% to 4.1% last month.
So this reminds me of when I saw Jay Powell. I think I was on 13th row. He can't say what he's thinking. Every word he has to say is written down, measured, because every single person who watches No, maybe I shouldn't say that. Every single word, there we go. Every single word he says is watched with a fine-tooth comb. If he says one word that deviates from what he specifically exactly means, the whole news cycle can be about Jay Powell says, recession on the horizon. Jay Powell says this, right? But I feel bad for the guy in that regard, because he can't even say what's on his mind, because every single word he says is just picked apart in every little detail.
The unemployment rate remains low and is held in a narrow range between 3.9% and 4.2% over the past year. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. The labor market is not a significant source of inflationary pressure.
Since the COVID spike, the Fed has been able to keep the unemployment rate extremely low, which is great for workers. You want an economy to have high demand for workers and strong participation. Businesses needing to compete for labor are forced to raise wages, which have been rising faster than inflation. But it can also get too hot, which is why it needs to be monitored.
Inflation has come down a long way from its mid-2022 peak. Data released last week show that total PCE prices rose 2.5% over the 12 months ending in January, and that core PCE rose 2.6%.
Low inflation and a thriving jobs market has been fueling decent economic growth.
Turning to the recent data, the economy has been growing at a solid pace. GDP expanded at a 2.3% annual rate in the fourth quarter of last year.
But the key phrase from Powell about the current environment is heightened uncertainty.
Recent indicators point to a possible moderation in consumer spending relative to the rapid growth over the second half of 2024. Further, recent surveys of households and businesses point to heightened uncertainty about the economic outlook.
The Trump administration has kicked off a number of changes. Changes to trade, of course, but also to immigration, government spending, and business regulations. And regardless of whether you agree with these changes or not, it certainly brings a fresh batch of uncertainty.
Uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
Powell is essentially saying that we might see some inconsistent economic data over the coming months, but that doesn't necessarily mean it'll persist for long enough to cause a serious downturn. And maybe the most important part of the speech was around the economic factors that people always forget when recession fears are stoked.
I would put down the U.S.'s outperformance to three things. One would be structural characteristics, and that's more flexible labor market, highly developed capital markets, culture of innovation, rule of law. Thing two is just population. We had a big population increase in 22 and 23. And what was the third thing? Productivity. So we had a really significant burst in productivity. So we don't really know how long this burst in productivity will be sustained.
Technological development has been an enormous factor in keeping the US economy moving forward, and it too is a huge question mark. Just taking artificial intelligence, for example, nobody has a clue how impactful it'll be to productivity. So putting a number on economic growth or a date on when a slowdown is coming is just something that's impossible. And the man who's repeated that philosophy for decades also recently had something to say about all of these economic concerns. He also happens to be one of the greatest investors of all time. Warren Buffett did an interview with CBS last week, and while its focus wasn't investing, his company, or even the economy, he did end up answering some questions about it. Well, to be more accurate, the host tried to get him to answer questions on it.
Can I just ask you a couple of questions about kind of how you see the state of the economy right now?
Well, I think that's the most interesting subject in the world, but I can't talk about it now. I really can't.
Buffett did share his views on tariffs during the interview, but he generally steers away from talking economics, precisely because it's kind of like trying to predict whether it'll be raining in 78 days and 4 hours.
We run our business so that we don't depend on everything being hunky-dory always. We run it so that we will be the last man standing. And
what the economy is going to do in the next year doesn't even matter to Buffett, because he's only buying businesses that will thrive regardless. But he did have something rather amusing to say about tariffs.
How do you think tariffs will affect the economy?
The tariffs are actually, we've had a lot of experience with them. They're an act of war. Over time, they're a tax on goods. I mean, the tooth fairy doesn't pay up. You always have to just, and then what? You always have to ask that question in economics. Always say, and then what?
Economics is like the physics of money. You can never just do one thing. There's always a reaction, and a reaction to the reaction. The COVID situation is the most blatant example. Governments needed to borrow lots of money and spend big to protect people and businesses. And central banks needed to lower interest rates to encourage spending and investment. But the consequences of being so aggressive with stimulative policies is the inflationary period we've seen since then.
Consumer prices keep going up.
Actually, I want to go back to that inflation chart. This chart is really interesting to me because I don't know if you remember, around this time right here, there were so many people screaming about how inflation's over, inflation's over, inflation's over. And the problem here is that this is a period over period inflation point, not a cumulative inflation point. Do you remember back? I remember back in this time frame right here, how they were saying, oh, we want to get inflation up to 2%. Do you remember that? Man, if only these days. But when you see the inflation chart look like this, and you see it start to come back down on this side, that's not necessarily a great thing. And the reason I say that is because this is not cumulative. This is periodic. So for example, this point right here means it's 7 percentage points higher than it was a year ago, right? And if a year ago it was right here, that means it's 7 plus 5. Okay. It doesn't mean that inflation is coming back down. This is cumulative. In fact, let me show you a cumulative inflation chart. Images. Yeah, cumulative inflation chart looks like this. And that sucks, right? That super sucks. That's a little, the scale's a little bit off on that. Let me go to, this is a great one. I remember seeing this one many, many times, right? Open in new tab, make it big. There we go. So if we compare like cumulative inflation, now this is up to the end of 2024 or January 2024 versus periodic inflation, it sees a very different story. On this chart, you're like, oh man, freaking sweet. Prices are coming back down. This is awesome. But the reality is it's still 6% higher. It's still 5% higher. It's still 3% higher than it was when it was 6% higher. What? Yes. So 2024, it was around 3% at this point right here. If we go to the same point right here, 2023. So it's 3% higher than it was here when it was, let's say, 5.5%. And if we go to this point here, it was 7%. So it's 3% higher than it was when it was 6% higher before when it was 7% higher. Do you see like inflation? That's why it hurts so bad. That's why what you feel today hurts the way that it does. Is while they want to say inflation is cooled off, things are so much better now. In reality, this is what's happened to all the prices. This is what's happened to all the prices. Yeah, prices are still higher than they were before. They're even higher than they were before that. Lars is like, wait a minute, what? Yeah, dude. Like, this is why, and listen, I've made 2,000 videos on YouTube. Some of them were about specifically this. I would stand on a soapbox and only 12 people would listen and talk about how big of a deal the fact is that we still have 3% inflation a year after we had 9% inflation. That means prices were even higher. The 3% on top of the 9%. What's up, Van Man? Dennis. Yeah. This is scary. And this has been really frustrating, right? Just think of anything in your life. What in your life costs less than it did in 2021? Probably nothing. Ashley's right. It's compounding inflation. Angry Baker has a quote here from Buffett. I could end the deficit in 5 minutes. You could just pass a law that anytime there's a deficit of more than 3% of GDP, all sitting members of Congress are ineligible for re-election. That's pretty funny. I like that. So let's continue on here.
With stimulative policies is the inflationary period we've seen since then.
Consumer prices keep going up. When's the end in sight?
No, prices will be higher 10 years from now and 20 years from now and 30 years from now.
But all of this talk of higher tariffs, inflation returning, and slower economic growth is still only about half the picture. There's another important reason why stocks absolutely tanked on Monday. Valuations. When you buy a stock, you're basically buying a claim of ownership on what the business currently has and what they might produce in the future. The higher the price you pay for the stock compared to its current profits, naturally, the more its profits need to grow in the future for you to make a good return. For the whole stock market, you compare the price of the S&P 500 index to the profits of those companies. And today, the market is relatively much more expensive than across most of history. And even more interesting, you can actually look at how stocks have performed based on how expensive the market was at the beginning of the period. JP Morgan did this over 27 years, and it shows that when markets have been this expensive, the next 10 years of stock returns have always been between +2% and -2% per year. Quite the change from the 20+% per year returns we've had in 3 out of the last 5 years.
And that right there is what I think a huge portion of the population has absolutely forgotten. Yes, 3 of the last 5 years, we've had 20% returns. Now, 2022 took until 2024 to get back to break even, okay? But during this point right here, it went up 20-something%. During this point right here, it went up another 20-something%. This point, it went down 20-something%. But then over here, it went up 20-something%. Right? Plus 20, minus 20, and then plus 20 here and plus 20 here. These moves are bonkers. These moves are crazy. All right. This is not normal, if you want to think of it that way. But because people have been conditioned that the prices always go up, I feel like we have absolutely forgotten what risk is. And when the market just has an itty bit of a sellback, not sellback, a sell off, any bit of a pullback / sell off, there you go, a sellback. It's like the vultures come out. It's fear across the board. Everybody's scared to death. And it shouldn't surprise you because they're so used to winning, which is a great thing, that they've forgotten about risk. And as a trader in the market, as an investor in the market, you should always be thinking risk first. Because since Warren Buffett's in this video, he has 2 rules. A, don't lose money. B, refer to rule number 1. So when you forget about risk, you can leave yourself to where it may take you 2 years to make back an investment. And annoy one, you had a dead decade from 2000 to 2010. That is risk, right? When you go 10 entire years, or in the NASDAQ from March 2000 to 2017, 17 years, right? You have forgotten about risk. We expect more, we want more. Yeah, a lot of people expect that. And a lot of people have come to the market like they're gamblers rather than investors.
But it's also important to remember that even this doesn't prove that the stock market is overvalued. The market is expensive relative to past periods, but it's also entirely possible that companies grow earnings faster than past periods and that prices are justified. We'll really only know if today's market was expensive in hindsight, when we look back and see how profits grew and whether they met our rosy, optimistic expectations. But I think going through this stuff does help to keep your expectations in check, because 20+% yearly returns is not normal. I hope you guys enjoyed this very quick update, and if you did,
that was a great video. I mean, how many times did I saw? I didn't have any single thing to criticize about his video. By the way, who am I? I know I'm some random guy on the internet talking over everybody else's videos, but my name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. Now, I want you to rank this video out of 10, and of course, I want you to subscribe if you haven't already. So, where would you rank this on the scale right here? Let me get the one from this morning real quick. Where would you rank this on the scale? For me, this video is quite good. As you saw, I had no points that I disagreed with. And the points that I made were just agreeing with him. In fact, this one may be worth a 7, Paul. This may be the one time it ever gets a 7. Golden Oldie says a lower tier A, which also would be a 7. So generally, I picked up this whole nobody gets a 7 from Tim Ferriss. If you don't know Tim Ferriss, he's an author. He's written many books. But one of the things with not having a 7 is it makes you think more critically about something. Either it's really great or it's not worth your time, right? And we go through a lot of videos that are not worth our time. Ironically, Jeremy, of all people, had a video this morning that was decent, which is crazy. So let's get the screen cap of this real quick. And let's put it on the ranking right here. Where would you put this? Ashley says 8. Rick says 6. Steve says 8. Wait, what? Okay, I misread that, Pete. He was about to say 7. I mean 8. 8, 8, 8, 6, 8. Yeah, I'm good with an 8. Nobody gets a 10. That's a rookie score. I'm gonna put that as an 8. Finally, I'll tell you what. Last week I was saying how I feel like a total dick because everything was bad. Like it felt like every video we watched was really bad. That one I have no problems with whatsoever. I absolutely would rank it as an impressive video for sure. Yeah, Van Man, Jeremy had a good video. I missed this morning. Don't worry. At 3 o'clock Central Time, the replay goes up live, so you'll be able to watch it. Now, let's change gears and go over to today's member highlight. All right, so before we jump into the member side of it, Mahesh was over in our Discord talking about some great new changes here inside of Outlier. So inside our Discord, we have a channel that's specifically related to product related announcements. And so this morning he put out this post. Here's a few small updates that went in today. Heat map value display changed from 0 to 100. So let's look at the SPY real quick. And by the way, things are loading faster. That was pretty cool, right? I don't know if you noticed that, but it totally is loading faster. So the fear and greed heat map, we changed the name from behavioral heat map to fear and greed heat map. And now it goes from 0 to 100. So for example, today the SPY is at 35.07. So 0 to 50 represents fear, 51 to 100 represents greed. When we say heat map moving up, it means it's going from 0 to 100. So it should be a bit easier to understand, right? Before we had 0 to 50 on greed, 0 to 50 on fear. So when it was moving up in fear, the value was going up, which was a little bit confusing. So now it's a perfect 0 to 100 score right there. Notifications. When you click on a bell icon, you have a new simplified notification menu, which I will absolutely. So we had a meeting this morning between Mahesh, Mark, and myself and someone else. And we had a lot of conversations specifically around the notifications, which I will be using the mess out of. So for example, if I was buying the S&P here when it has a heat map score of 35, I could come up here and I could say, okay, if it goes to 45, maybe that's where I want to take profits here. So if it gets up to 45, then send me an alert. If it's moving up, notify me if it goes to 45 or above. So even if it gaps through 45 and goes straight to 50, I'll get my alert. Or if it's at 35 today and I want to make sure that I get out before it goes against me too much, I might say, okay, send me an alert if it goes to 30 or below. Also, if the heat map has no change, so if it's still at 35 tomorrow, shoot me an email, let me know, because that's not what I want. I want it to be either getting more fearful or greedy. I don't want dead money. And of course, the buy or sell signal, uptrend or downtrend started. Those haven't changed, but these right here, I will be using on every stock that I put in my portfolio. And I think that is really, really cool. So I'm really glad to see these upgrades go through. The market breadth chat tab has new charts. So let's go look at that real quick. All new charts inside. That was the wrong one. Oh, by the way, if you have a saved screener, you might have to redo it because the heat map values over here are now from 0 to 100. And before it was, R50 and G50 and all that stuff. Now this has changed. So you'll need to update your screeners, but for the better. Let's go to market breadth. These are the brand new charts that we're super stoked about. Now, we'll be getting those charts inside of the dashboard here soon. But for right now, these are the first iterations of the charts going through into the market breadth tab. And I think they are slick. First off, they load fast, really, really fast. And as you can see, it is super crisp, super snappy, which makes it way, way better to use. And this was really cool. I looked at it earlier and I was like, I wonder if this is crossed yet. Let me look. And I zoomed all the way in and I was like, oh yeah. The green line definitely crossed over the red line. I was like, okay, I like this. You can zoom all the way in and see right to the detail, which I think is pretty darn cool. So thank you for putting that out there, Mahesh. Also, the dashboard now loads in at 1 year by default instead of the max view, which increases the speed at which this loads in because it has so many less data points to pull in, just 1 year versus all the years, basically. So huge upgrades today. But let's change over and talk about member highlight. And Albertone, listen, Albertone, I'll do this solid for you today. But yesterday I answered your question on live stream. Today I'm going to answer your question on live stream. But I got to share the love, my friend. I have to answer other questions as well. So his question was, I am currently planning a significant entry at the next SPY cross over the 50 EMA. What type of duration of option would be optimal for a strategy based on entry and exits around the 50 EMA crossovers? I know this is a strategy often mentioned by Chris, but not sure if 20 to 25 days would be optimal for this. So for me, I go for 21 days or so, give or take. That's where I start. And in this strategy here, He's like, listen, I don't want to go for a 21-day option. Where can I go? So I would say if I were looking at this, maybe 50 days, still deep in the money, I would absolutely personally go still deep in the money, but I would look more like 6 months out. If you're looking to trade on a stock that is only moving, maybe once every 6 months, maybe even a year out, on those options. Because, like, for example, this cross happened in May of 2024. This cross happened in July. So he could have gone 3 months, absolutely would have made money on that option. And then he could have done it again in September, and then maybe got out in December. So 3 months right there. So if you're trading on a longer term time frame, you definitely want to go for a longer dated option. But of course, you want to keep that extrinsic value, because options have both intrinsic and extrinsic. You want to keep that extrinsic value as low as you can. Then it's a real leveraged investment at that point. So that's where I would go, Albertone. Good question. Let's also go into share your big wins real quick. Paul Dennison of the Deep. He was our one yesterday that we talked, or a couple days ago we talked about, but Senior Wahoo. I know he likes to watch live. Senior Wahoo. So glad I found Outlier. I was chasing the next big win following other channels and dreaded opening my Thinkorswim account because it was always red. Here's the deal. Here's a real deal. There was a few years ago where I would check in my account, just do my normal thing, and it would all be winners. And I check the next day, and it'd all be winners. And I check the next day, and it'd all be winners. And that's how trading is supposed to be. And it's not me trying to flex on you or anything, but the reason that it was all winners is because I would get rid of the losers. I even have a video on this. If you want to go look it up on YouTube, like I say, I've made 2,000 videos so far. It's called Throwaway Trades. If you see losers in your account, just throw them away, get them out. Keep your winners. Let your winners run as far as they can. But if you have a loser, take it and throw it out. So every time you log into your account, it should be filled with green or cash, right? If you're looking at your account and it's full with red, you're doing it wrong. So that's actually pretty cool that he talked about how he was dreading opening up his Thinkorswim account because it was always red. Glad to report he's in the green and no longer sweating opening up his brokerage account. I wasn't losing any sleep, but I was pretty close to just sticking everything into a Vanguard ETF and giving up on trading until he found Outlier. So I thought that was pretty great. I would like everyone to drop in the chat to pay respects to Senior Wahoo, a big letter S. Everybody drop a senior Wahoo letter S in the chat to pay respects to Senior Wahoo there. So congratulations to him. I'm glad that that's working out. Mahesh is a 10. Mahesh is totally a 10. So the platform should work all over the place, my friend. We have customers all over the world, but right now it's just US-based stocks. We will be adding crypto and even more stocks soon. What time frame does it alert you on? So it should send you an alert overnight, and yes, it'll be on the daily time frame. Totally great updates. Hans is asking order blocks, which will be called outlier blocks, by the way. Mahesh is saying 3 to 5 weeks out on the outlier blocks, which I'm really excited about. So yeah, everybody paying their respects to Senior Wahoo with the S in the chat. Very cool to see. I really like it when we can pay our respects like that. I think that's really cool, right? Congratulations to him. And congratulations to all of you for being outliers and being here today with me. Let's move on. And of course, be sure to share your stories in the Discord. I want to showcase you next time. The first rule of Outlier, as you know, is to tell everybody about Outlier. And if you're getting any value from these videos, the easiest way, the best way that you can pay me back is to tell more people to come watch these videos, right? This is what we are trying to do, is take over the world. I mean, I'll be very honest here. We're trying to take over the world. But in reality, we're trying to keep people from losing money, right? We're trying to help you save time, make money, and start winning with less risk. And of course, I want you to hit the like button. So if I were to trade today, which I know I'm not, but we're going to try anyway. Let's get back to trading in the Outlier trading room. So what is Outlier and how does it work? Well, Uncle Warren, as we saw earlier, he says, be fearful when others are greedy and greedy when others are fearful. Outlier shows you if investors are acting irrationally fearful or greedy and by how much, allowing you to get into the move before, or get into the stock before the Outlier move happens. And if you're ready to save time, make money, and start winning with less risk, you can save 64% on the annual pass over at outlier.com. That's literally 82 cents a day. And if you're on a trial, just shoot us an email that you're ready to upgrade and we'll take care of it from there. Now, my style of trading using Outlier is called the Golden Ticket Trading Strategy. It's where only price pays. So it starts with the market. And right now, the market, as we know, is very, very bearish. Let's close a couple tabs to zoom in here. Close a couple tabs, get to today. Yeah, the market is very bearish right here. But I've been telling you, got receipts. Go back the last couple days. I said, I think we're ready for our short-term bounce. It's almost like I know what I'm talking about. It's almost like I know what I'm talking about. What do we get here? A bounce. The S&P is up about 1%. NASDAQ's up about 1.5%. Now, where did I get that from? Right? This is a bearish trend, Chris. Where are you getting this from? Well, the Outlier trend template would tell you this is a bearish trend. With your 10 EMA under the 20 EMA, stumble over my words there, live streams. 10 EMA under the 20 EMA, price under the 50 EMA. And that'll tell you right there if it's a bullish trend or a bearish trend. Next, we have this outlier block down here where not at all surprised to see this bounce right here. But I wouldn't I would not counter trend trade. I don't counter trend trade anything. No way. That's hard trading. I want easy trading. This right here was no surprise because the next step was market breadth. When we look at the market breadth, we can see here as we zoom all the way in, the green line is over the red line. Well, what the heck are these lines, Chris? The green line is the percent of stocks on our bull list. Our bull list is our buy signals. How many stocks are showing on our bull list today? As of today, our bull list, our buy signals, 45%. 45.22% of stocks we cover have a buy signal. And that has been increasing. And that's why we have the crossover today. Now, you're probably thinking, what do you mean all these stocks have buy signals? What do you mean there's more stocks getting buy signals? For me, I'm looking at this like short covering. I'm looking at this like all these stocks that have been beaten up are now getting buy signals because the sell signal is alerting you to sell to close, meaning take off your shorts. That is how I interpreted that. And that's what's going on in the market right now. A little bounce. I'm not saying it's going to go back up forever. I don't know where it's going to go, but we're going to let that see. We're going to let that play out because it takes a couple weeks or so, at least a week, maybe two, to see these movements in the market breadth. And it's really interesting, really helpful to have this, right? And so I combine these things to make what I call the master key. Now, the master keys give me greater than 80% win rates. Last year I had a 92% return only following the master key. When I turned the master key on in May, not even the whole year, from May to December, 92% returns. Not too shabby, right? So the master key includes the buy signal on the SPY, buy or sell signal. When all these align is what I'm trying to say. So we got a sell signal on the SPY. The market trend is bearish, but market breadth is getting bullish, right? Because of that, I wouldn't be taking any trades right now, for me personally, long or short. Now, sector breadth, I don't even look at until I find some stocks that pass the other parts. But for me, this is going to lock me out. The master key is going to lock me out. But that's okay. While no stock set up for me today, I want you to drop your stocks in the chat and let's take a look at what you want to see, right? Let's take a look at stocks you're looking at today. Now, I have a request. Type in your stock and then type in long or short. So, for example, Jesus wants to look at Walmart, Dollar General, and Target. Geez, Jesus, I had to start charging you for this, my friend. Jesus says all of those down. So you could say long or short, up or down, whatever the case is. So Jesus wants to look at Walmart first. So let's go into Outlier and let's run this together and see just how much faster this is. So Walmart. Bam. That is a lot faster, isn't it? Cool. And then I don't have to change the view. I can just zoom in. So Walmart got a sell signal. See, that's a lot faster. Walmart got a sell signal on February 21st and has definitely come down. At that point, the fear and greed was at 90. Oh, you can't see that. Sorry. Let me get this bigger. Move my fat head out of the way. Walmart was at a fear value of 90. I'm sorry, a greed value of 90.86. It maxes out at 100. So it was almost maxed out the greed value here, which is crazy. And then what happened? This is a huge pro tip. The further it goes into the fear or into the greed, the more likely it is to snap back like a rubber band. Keep that in mind. Anytime you see something with a 90 score on the greed, watch for it to snap back. So so far that's good. Let's look at our 10, 20, 50. Yeah, the outlier trend template would say all of this is definitely an idea for a bearish setup. But the staples sector, this is a defensive sector, not defensive like Raytheon or Northrop Grumman or Lockheed Martin. Defensive as in when the market's going down, people look to put their money into a defensive sector, which is why the staples sector is getting more greedy. And Mahesh did say that we will have the score of the sector coming soon on the next upgrade as well. But let's take a look at Walmart real quick on the chart here. Yeah, for sure. Now, I will tell you, if I were looking to short this, I would look for a couple things. First, I would actually look for a bounce back up. Sounds crazy, but I would look for a bounce back up because right now, if your trailing stop is the 10 EMA, let me move this over to give you some perspective. If your trailing stop is the 10 EMA right there, you've got 7% of risk to find out if it's going to work. But if you were to get in, like, let's say right here, right, let's say the candle's right there, you might have 1 to 2% of risk to find out if it's going to work before you get stopped out. I'm a huge advocate of keeping your risk as small as humanly possible to see if your trade is going to work. So for Walmart, in this case, I would wait for it to pull back a little bit. But then again, you could absolutely go short at any time on any stock. Just make sure you know where your risk is at. And Jesus, in the effort of fairness, I'm going to move on to the next one, my friend. Because I saw PM Indy. I'll just call this person PM Indy. First post. PM Indy, first off, I want to say you are awesome. Thank you so much for coming. Thank you so much for being here on the live stream. And let's take a look at this, right? If we look at Disney, man, Disney's been all over the place, right? All over the place right here. But the greed score got super high back in December and is getting pretty much in the fear area over here. Sitting at 47% on fear, and the communications sector is also in the fearful area. I assume that, okay, Disney puts, yeah. Let's go back over here real quick. Same thing. I would be waiting to find a little bit less risk if this was my trailing stop. But then again, if you have a different plan, and that's the important part here, is what is your plan to get out? If you have a different plan for your trailing stop that keeps it less risk, then could be great. However, tell me order blocks don't work. Tell me order blocks don't work. The further back they go, the stronger they are, by the way. So this is October of 2024. The very first, look at this, is so crazy. The very first time Disney came down to this order block, it's bouncing right off of it. Tell me order blocks don't work. And another example of you don't have to hold it if it goes under the 10 EMA, right? A 20% gain right there is all gone on this side. You don't have to round trip anything. So good one there. Mr. Indy, thank you so much for coming. Good to see you, my friend. Ben wants to look at BTI on the long side. BTI. Snappy. Real snappy. I'm happy with that. That's a great upgrade. All right. So buy signal came, looks like today. Fear and greed is at 69. So this is definitely moving up. That's what I want to see. And the staples sector is also getting more greedy. So, dude, this is what I want to see. And when I'm looking for a stock, this is what I'm looking for. I want the stock to be trending up, which we see. I want it to be getting more greedy in the stock. And I want the sector to be getting more greedy. The only drawback to this is that 40% of a move in a stock is due to the market. 30% is due to the sector, and then 30% is due to the stock itself. So you've got 40% of the market working against this one, unfortunately, on BTI, British American Tobacco. But the sector itself is super strong. The stock is super strong. If the market were there, it would be even more bigger. So this one looks great to me. Let's look on the chart real quick for any order blocks, BTI. Oh, man, what a great entry right there. Yeah. We don't have any earnings in the way. So it did pop down under earnings, but you can see how the strength came right back to it. Looks great to me. I like that one. And we did get at that buy signal today. The golden oldie Did you get a call from Nancy to take off your shorts? First off, it doesn't matter. The only person who's telling me to take off my shorts is my wife, and she ain't here. So it ain't gonna happen. My shorts staying on, my friend. My Under Armour gym shorts that I absolutely did wear to the gym today, that I'm still wearing right now, even though I have a suit coat on, are not coming off, my friend. AMD, Knight wants to just add a little bit of insult to injury for those who are long AMD. I see what you're doing there. I see what you're doing there. AMD. AMD. All right, so this is a great example of these buy signals and how I'm interpreting them. AMD got this sell signal back in October, and it got a buy signal, ironically enough, here in January. But that is not a buy to go long signal to me. That's how I interpret it. Not a buy to go long signal. A buy within a downtrend is a close your shorts signal right there. Close your shorts. So let's zoom in a little bit. I can't imagine anybody in their right mind looking at AMD going, oh, that's great. It's a great buy right here. It's a great buy right here. I mean, it is like going to zero, it looks like. Fear and greed is at 22 out of 100, very fearful. The tech sector getting more fearful. AMD itself, though, it's up 4.5% today. There it is. There's your bottom. This was the absolute total bottom right here, right in this order block. It can only go up from here. Of course, you know I'm being sarcastic, but tell me order blocks don't work. Even on a beaten down stock like AMD, tell me order blocks don't work. Yeah, I wouldn't be buying AMD with your money, is the way I'd look at it. Oh, Marco, you put this in the chat this morning, didn't you? I remember seeing it, but I remember I didn't get a chance to look at it. So Marco, look, I'm a real human. I did see you, my friend. All right. UPS, man, this is all over the place, isn't it? Huge gap down after earnings. Moving up right now, you've got the fear. It looks like it maxed out around 20 and has really come out. It's at 40 right now, 39.96. The industrial sector getting more fearful though. Let's look on the chart here. You still got the outlier trend template still bearish on this. So this is a no-go for me. But if it comes down to 114, it could bounce at that order block right there. Just, of course, Marco, make sure you keep your risk in check, my friend. Emmanuel says, why can't the direction of the arrows also say if it's to initiate a put or initiate a long? That's a good question. Really, we want to not specifically say buy puts, buy calls. I did actually ask for this enhancement, and Mahesh denied me. But I was asking for strong buys, strong sells versus weak buys and weak sells. So in AMD right here, AMD, the way that would have looked is like here within a downtrend, that would have been a strong sell. And then here within a downtrend would have been a weak buy. But then again, we want to give you the data to make your best decisions. So good question. Luca Tubo, how you doing, bud? Luca Tubo, SBUX. Luca Tubo wants to look short Starbucks. Dude, Starbucks is definitely losing some money on me right now. I gave up coffee for Lent. I'm a week deep at this point, and I'm doing okay. I'm doing okay. The first couple days, especially after the time change, that was rough. That was rough. But at this point, I'm doing all right. I drink a little sweet tea here and there, which I know it's got a little bit of caffeine. I'm not off of caffeine, but doing a little bit better. I'll tell you, I'm getting by. The fear value, the greed value peaked at 93 out of 100, and has been going down for a hot minute with the price of the stock. You can see the current fear and greed is at 56. The discretionary sector continues to be more fearful. Yeah, that one definitely from the short side looks pretty good. Luca Tubo, SBUX. And see, this is why it helps me when you tell me if you're looking long or short, because now I can give you a little bit better analysis. Yeah, look up here at these order blocks. They go way back. These order blocks go from December of 2021. It got monkey hammered right here in 2023. And again, monkey hammered right up here in 2025 on its way down. So yikes. That is pretty brutal. So listen, my wife is calling me. She's literally going to murder me if I miss this appointment. But listen, if you're an influencer of any size and any niche, we do want to work with you. Send us an email over at support@outlier.com, and I will personally be emailing you back with some great information. Of course, be sure to tell me what you're trading in the chat and come back tomorrow where outliers like us will save time, make money, and start winning with less risk together as a team. Now, YouTube is going to pop up a couple recommended videos. I recommend you watch one of those, and I recommend you have a fantastic day. I will see you tomorrow morning on tomorrow morning's live stream. We'll talk soon.
10 over 20 over 50.